Hey everyone, it's Karthik with MoneyVest. So markets are selling off quite aggressively over the last week here. The Nasdaq and the S&P 500 are both down. The Nasdaq is down over 1.5%. Actually, the S&P 500 is down over 1.5%, and the Nasdaq is down a little over 2% on the week. In fact, over 3% now, because it is down another 27 basis points today as of the time I'm recording this video. So I wanted to break down exactly where we are in the technical landscape with respect to the market and why I think it's really important for all of us to start getting ready for buying opportunities. As I mentioned before in my previous videos, that the markets don't give you a lot of opportunities to dollar cost average into, right? They don't give you a lot of deals or discounts, and the market sell-offs are very rare, right? Because in the past over 100 years, if you go back to, from the 1900s, in fact, we're going to be doing some analysis from the last 70 years. I'm going to show you some statistics and some data and how rare these market sell-offs really are, right? Because majority of the times, and I'm talking over 60%, 70% of the times, the markets are very much within all-time highs. So it's very rare for us to see these types of sell-offs. And that's exactly why it is important for us to take advantage of these opportunities when markets are selling off, and for us to dollar cost average into and deploy cash into the market, because we're going to be getting some good deals very soon. So first things first, let's take a look at the markets here. Nasdaq this week, like I said, is down over 3%. So we're seeing a very nice red candle, and I think it's really important for everyone to understand that red is good. Okay, when markets are selling off, that is actually a good thing. If you are an investor in the markets over the long term, if you're planning to invest, or if you're just getting started, always remember that red is good, right? Of course, we keep hearing the saying green is good, because green means markets are going higher and everybody's making money, everybody's excited and happy. That's great, but in order to get good deals, in order to actually find opportunities and deals and discounts, there has to be a sell-off. If there's no sell-off, then you are really betting on that momentum to continue, and that doesn't go on forever, right? As we already know, markets are like pendulum, swinging from one side to the other. If there's going to be euphoria and greed and overbought conditions and markets just ripping and rallying higher, there's also going to be the other side of the coin, which is more geared towards fear and sell-off and pain and suffering. And if it doesn't feel like you're throwing money into a fire pit, then it doesn't really mean that there's pain out there, because we've gone through that ourselves, our community, back in 2022 during COVID and even 2018 sell-off. I've experienced it many times where when you're putting money into the market, it should actually feel like you are just lighting up your money in fire, right? That's how it feels, because you're actually getting that stomachache of just investing into something that's just coming down and selling off. So this right here is going to be some thresholds, which I think is really important for everyone to understand. Now, a lot of these terms get thrown around in media, on YouTube, in a lot of different places. So I just want to set the record straight that right now we are in a dip. So this is where we are, right? So at the moment, the markets are in a quote unquote dip. And a dip is only possible in an uptrend. Okay, when people say buy the dip, they're really referring to the dip that happens within the context of an uptrend. Uptrend meaning the markets are making higher highs and higher lows. So if I essentially bring up some very simple technical analysis here, what you'll notice very quickly is that the markets are very much in an uptrend. So this right here is a higher low. This is the Nasdaq we're looking at, and this right here could be referred to as a bit of a higher high that the markets are making, or you could go even further back, kind of label this as a higher low, and then of course label this as a higher high. So the bottom line is that we are in the context of an uptrend, meaning we're pushing higher. So right now, since we are within 5% of all-time highs, we are in a quote-unquote dip, because we're still in the context of an uptrend. And I can show you that over here as well in the S&P 500, as this is again the entire sort of uptrend that we are seeing for the market. As you can see, the higher highs and the higher lows continue. Now, a pullback is referred to when the markets are down more than 5% but less than 10%. Okay, so if you're within 5 to 10%, of all-time highs. All these numbers are quoted with respect to all-time highs. So since we are within 5% of all-time highs, even though we are selling off, we're in a dip. And if we cross that 5% threshold and we are now down over 5% from all-time highs, we are in a pullback. And that is going to be 5,102. That's going to be the level for the S&P. So that's going to be the S&P level for that index, right? Because I've calculated that using a very simple formula. Of course, this is the all-time high at 5669, and a 5% pullback is going to put us down at 5386. Currently, the S&P 500 is trading at around 5527. So if we trade down to 5386, that's going to put us down over 5% from all-time highs, still within a dip. If you cross that level and if you trade all the way down to 5102, which is 5100, that's going to put us down 10% from all-time highs. It's going to be referred to as a pullback. And I believe at that point, we're going to be breaking down this first support level at 5260, which I'm going to come back to. These are mostly technical levels, but this is going to put us into a pullback zone. And if you were to see a correction, right, that's when the market correction comes into the equation. That's going to be over a 10% sell-off from all-time highs, but within 20%. So over 10%, but less than 20% is going to put us into a correction. That's going to be a 4,500 on the S&P 500 from all-time highs, almost a 1,100 point drop in the S&P from its all-time highs of 5669. If we are over 20% down from all-time highs, which we have seen back in 2022, the markets were down quite aggressively. So if you come back, this right here was the entire 2022 sell-off. So what really we experienced was over here, down over 13%. So first we experienced a correction, then the markets recovered, right? So we were within dip range, then we sold off even more. Then we essentially were down 23%. So then we entered a bear market and we stayed there until October of 22 before, of course, recovering back and, of course, now trading back at all-time highs. So over a 20% sell-off is going to put us into a bear market. That's going to be 2,800 for the market. Just want to make sure that is actually not correct, because if we are down, so let's just do 79, that's going to be 44.79 as the index level. So if the index actually hits that level, we're going to be down over 20% from all-time highs. That's going to be 4479. So just under 4,500. It's going to put us into a bear market for the S&P. And of course, a crash is referred to as a sell-off, which is greater than 50%. And for the most part, a lot of people use crash as clickbait. Unfortunately, I'm also guilty of that because of the likes and the views and the clicks, and everybody is kind of going crazy over a market crash. But really, in actual terms, crash is only referred to when the markets are down over 50%. Everything else is very, very small in the grand scheme of things. If you look at the bigger picture, it's within a dip or a pullback or a correction range. And these are the S&P 500 levels. Now, the crazy thing is that what blows my mind and something that I really want to address statistically here is that over the last 69 years, so going back as far as 1950, what you'll notice is that the S&P 500 for the last 69 years has spent 48% of its time within 5% of all-time highs. So almost half the time spent within 5% of all-time highs. Absolutely bonkers. If you take a look at the pullback within 10% of all-time highs, not 5%, but within 10% of all-time highs, that is over 64%. So that is even greater, obviously. And if you take a look at correction, which is within 20%. So in other words, in the last 69 years, going back as far as 1950, the markets have spent 84% of their times within 20% of all-time highs. So just to put things in perspective a little bit, if the markets actually drop over 20%, if we enter a bear market, right? Let's say for whatever reason, whatever catalyst, we see a bigger sell-off in the markets in the weeks and the months to come, and we are down over 20%, we trade all the way down to 4,400. That has only happened 16% of the times for the S&P 500 in the last almost 70 years, going back as far as 1950. So that just goes to show how rare that would be if the markets were down over 20%. That's exactly why, for me personally, statistically speaking, if the markets are down anywhere between 10 to 20%, if not more than 20%, it becomes a very, very lucrative opportunity for me to buy aggressively into dollar cost average, because that I know for a fact that it's happened very, very rarely. It's happened fewer times, and the markets are more susceptible, more prone to trading within all-time highs range than being down over 20%. That's why we've seen a bigger picture and a long-term view of the market just continuing to rip higher and higher. If you essentially looked at the markets and the markets were going down and we were trading at an all-time low, of course, for one, nobody would be investing in the markets because they would think that there's better ways to make money. And number two, majority of the times markets would have been down, right? They would have been traded near all-time lows. But this is in the context of all-time highs. And that's why the US markets are so strong, attracting so much liquidity because of this performance, right? They've done really well over the last 100 plus years, especially going back almost 70 years, where they have traded 84% of the times within 20% of all-time highs, and of course eventually recovered back to all-time highs. So those are some data points, some statistics that I wanted to bring over. Of course, our MoneyVest index kind of takes into account a lot of that, and we're at 3.78, something that I've mentioned before. Yesterday we were at 3.83. And right now, of course, we're selling off a bit again. And if you come down to that yellow zone or down to that green zones here, that's going to make it even more attractive, more lucrative for us to dollar cost average into the market and buy a little bit more aggressively. So the whole point of this video, and again, just a bit of an idea to give you some things in perspective. And before I get there, do check out the MoneyVest platform. So again, this right here is going to be the entire platform which you can access to complete your full comprehensive fundamental analysis. There's currently a 51% discount if you're interested in joining us, and that discount does expire at the end of this month. You can lock that pricing in. It gives you access to a lot of amazing features. We're going to be adding a lot more features over time, including an earnings calendar. Our MoneyVest index is going to be eventually here as well as the S&P 500's technical and fundamental positioning, and data stuff like this is going to be available on the platform as well. So it's going to help you make better, more informed, confident investment decisions. So link's going to be down below. So the bottom line is that don't let this opportunity slip away as the markets continue to sell off. I'm going to be sending out a lot of alerts for my buy targets, for my shopping list, and for my actual alerts when I'm actually deploying cash into the market, because as I mentioned before, very rarely do we get these opportunities from the market. And one more thing I want to mention is volatility. So if you come over to the VIX over here, we're starting to see a bit of a spike here. So 30% increase in the volatility just this week. And if you get into this green rectangle, that's going to be our first cue, first signal to actually start buying into the market and be a little bit more aggressive. It's not like I haven't been buying. I've still been dollar cost averaging here and there every single week, but it's going to give me the signal that I need to be a little bit more aggressive, and a lot more aggressive if it gets up to over 30 to 35. And that's going to be the second green rectangle, second area where I consider the markets to be somewhat oversold from a technical standpoint. Of course, the MoneyVest index is also going to be much lower as soon as volatility spikes here, and only 2 times in the last, I believe, over 30 years. So going back as far as, I'll just wait for this chart to populate. So going back as far as 1990, so we're talking over 34 years, only twice the volatility was at over 60. And that's happened during the great financial crisis, the great recession of 07-08, and of course the pandemic of 2019 and 2020, only twice. So again, if it actually gets up to that level at over 60 to as much as 75 and 80 and 90, that's going to be a no-brainer buying opportunity for me in the markets as well. So to keep you guys updated, again, join our Discord, join our Patreon, 51% discount. We're going to be providing you with some very high-level information and some alerts and analysis on when it's a appropriate time and the risk reward is really favorable, so that you can make more informed, more confident decisions. Again, link's going to be down below. We'd love to have you on board. So let me know what you think about the markets and where we are. Technically speaking, we are starting to see a bit of a pullback. A lot of individual stocks, including the Magnificent Seven and technology stocks, are rolling over, considering how overbought they were. So buying opportunities are going to be coming our way. So link's going to be down below. We'd love to have you on board. As always, happy investing. I'll see you all in the next video.